Warren Buffett, as an example, has more cash stored on the sidelines than ever before. His Berkshire Hathaway has, between cash and short-term treasuries of very short-term durations, almost $148 billion sitting on the sideline. The bottom line is that for people to think that all is okay, we are in the height of instability, of change, of risk. And I think anyone who would think that they've already reached their retirement and they're okay, certainly they're not thinking about their legacy. And if they are only thinking in terms of short term, look, things seem to happen on a dime. And when you talk about these banks that can overnight be bailed in, there's a lot to think about nowadays. And status quo, even the best laid plans done again, they need to be reevaluated from time to time. And in my 33-year career, I have never seen a more important time to reevaluate where you are personally on this crazy journey to retirement. This large, still inverted yield curve. And what the inverted yield curve is basically saying to guys like Warren Buffett, who have loaded up on short-term treasuries, is that the Fed, when things get really tight, will pivot and lower rates. And when rates lower, that means all of the the $147 billion in short-term treasuries that Buffett has will instantly go up in value as rates fall, and those bond prices in circulation go up commensurate. And so he'll be flush with cash, with the ability to come in and take advantage of whatever opportunities arise in the environment that is coming. And when you see a guy like him on the sidelines, I find it to be very, very ominous, at least in terms of what we could expect to see in the broader market.
Hello and welcome to Crypto Street, where we bring you the latest and most intriguing stories. Now, let's begin our enlightening discussion with Andy Schectman.
Yeah, well, there's the old saying, you can't get out of the way of what you don't see coming. And a lot of people, maybe even those that are well-read, are just reading the wrong things. But let's look at a couple of market gurus and look at what they're doing right now. Warren Buffett, as an example, has more cash stored on the sidelines than ever before. His Berkshire Hathaway has, between cash and short-term treasuries of very short-term durations, almost $148 billion sitting on the sideline. And he's known as the most classic value investor that there is. So he is anticipating greater value ahead. And it is my belief that if he thought there was such great value in this market, he would have all of that money deployed rather than being in short-term treasuries. And maybe equally as interesting, Michael Burry, the gentleman who called the subprime crisis, who had the book written and the movie made after him, The Big Short, just shorted the market with 93% of his entire hedge fund, $1.6 billion, shorting the market. So you have some very, very big players on opposite ends of the spectrum, a legendary speculator and a legendary value investor. Both of them are sitting on the sidelines in the respect of in cash or shorting what would be, and I guess it's not right to call Michael Burry on the sidelines. He's taking a more aggressive stance and actually shorting this market. And, you could also talk about this large, still inverted yield curve. And what the inverted yield curve is basically saying to guys like Warren Buffett, who have loaded up on short-term treasuries, is that the Fed, when things get really tight, will pivot and lower rates. And when rates lower, that means all of the $147 billion in short-term treasuries that Buffett has will instantly go up in value as rates fall, and those bond prices in circulation go up commensurate. And so he'll be flush with cash, with the ability to come in and take advantage of whatever opportunities arise in the environment that is coming. And when you see a guy like him on the sidelines, I find it to be very, very ominous, at least in terms of what we could expect to see in the broader market. And we're also coming from a point where the values of the properties that people own have been blown sky high through a decade plus of suppressed interest rates and easy money. I would say the same thing about all the valuations that people are relying on to cushion their retirement. And when these valuations correct to meet a higher interest rate environment, to find equilibrium, they may fall a lot further than people think. And you put it all together on top of, as we talked about last week, a growing mountain of debt, where just since the debt ceiling increase, the government has added over $1.8 trillion in debt, most of it used to reliquify the Treasury's account that had been squandered. And well, we did that in just over 8 weeks. It took the government 209 years to create the first 1.8 trillion. And looking at it on even a bigger lens, you go back to the end of 2019, before the pandemic, and we had $22.7 trillion debt at the end of fiscal year 2019. And here we are today, 32.7. That's 50% greater in just a few years. The acceleration of this debt and the rise of interest rates is really a big problem. And then you throw into the mix, Fitch here today has said they're going to downgrade some more banks, including maybe even some of the big boys like JP Morgan. And when you see a banking industry that is being downgraded, a banking industry that, when you look at the regional banks holding 70% of all the commercial real estate loans and leases, and between now and the end of 2024, you have like a 1.6 trillion in these loans and leases that need to be reset. So as you see redemptions coming in with these banks, or problems with these banks, and the banks are forced to sell their longer term maturity bonds, that's like a self-fulfilling prophecy. They sell them and those bond prices fall, but the yield goes higher as a result to attract more business or more interest in those bonds. And so it puts more and more and more pressure on the unrealized losses of these banks until, for whatever reason, they're forced to redeem depositors' request for redemption, and they have to sell these bonds that are increasing in their loss profile. And that's why you still see such a huge amount of money in this new overnight, or this new short-term bank lending program.
Don't forget to join us as we explore the unfolding events. Now, let's look at the latest news in the economy. Then we turn back to Andy. Dollarization can lead to economic contraction and collapse of Argentine economy. Former U.S. Treasury official BRICS expansion will speed up de-dollarization, Chinese expert says. Economist Lord Jim O'Neill calls BRICS currency idea ridiculous, says China and India never agree on anything. BRICS bank issues. First czar, bonds as it looks to use local currencies. Morocco denies South Africa's claim that it has applied to join BRICS. That wraps up today's crypto news highlights. Stay tuned for more updates, insights, and analysis from the world of cryptocurrencies. Please share your thoughts in the comments below. Don't forget to like this video and subscribe to our channel for more engaging content.